Okay, everybody, good morning and welcome to the Monash Pavilion, where I'd like to start by acknowledging the traditional owners, the Kulin Nations, upon which Monash's campus in Victoria, Australia, are situated, and I extend that acknowledgement to any traditional owners and Indigenous people that come over to the pavilion today or join online. My name is Ben Thompson. I'm a senior lecturer at Monash, and you'll see me up here throughout the day, sporadically. We've got a lot on today. We've got sessions on oceans, large ocean states, blue carbon, but we're going to kick off with the one on screen here. So without further ado, I'm going to pass over to my colleague, Anke Leroux, who'll be moderating our opening session today. Thank you.
Thank you, Ben, and welcome everyone to our green panel on carbon offsets and the use of carbon offsets in achieving net zero in Australia. My name is Anke Leroux. I'm an environmental and behavioral economist and associate professor at the at Monash University. And this panel has been co-organized with Associate Professor Anita Förster, who's the director of the Green Lab. And Green Lab is a research hub out of the Monash Business School. It combines economics, accounting, banking, and finance. And we're looking to work with stakeholders in industry, the civil society, and government to support policy development or research that feeds into that. It's my absolute pleasure to introduce a very distinguished panel today. So first up we have Julia Gardiner. She's the Director of Multilateral Negotiations and Strategy and also the International Climate and Energy Division at the Department of Climate Change, Energy, the Environment and Water. We have Kurt Winter, who's Director of Corporate Transitions at the Carbon Market Institute. Tennant Reid, Director of Climate Change and Energy at the Australian Industry Group, and Dr. Kate Dooley, Research Fellow at the School of Geography, Earth and Atmospheric Sciences at the University of Melbourne. I would like to thank you all for coming today and for finding the pavilion. It's not always easy with this sort of sprawling COP28. Okay. The use of carbon offsets by Australian companies to meet their compliance obligations under Australia's revised safeguard mechanism and to meet voluntary net zero targets is increasingly under scrutiny. The integrity of Australian offsets has been widely questioned, prompting some reform and ongoing debate. On the international offset side, ensuring that these represent real and additional and permanent emission reductions or sequestration is even more challenging, with many international offsets certifiers facing serious criticism and backlash following the exposure of some flawed offset projects. So I would like to start with Julia to give us a snapshot of the Australian policy context, in particular the reforms around the safeguard mechanism and what that means for the use of carbon offsets by Australian companies, but also maybe if you could foreshadow some of the proposed reforms for the Australian Government Climate Active Standard and what that might mean for the use of carbon offsets. Thank you.
Okay, thank you, Anke. Sorry, the microphone's a little strange. But as Anke mentioned, I'm Julia Gardiner. I'm a Director of Multilateral Negotiations and Strategy at DQ. I hope you'll forgive me if I'm a little less than coherent. I was in a negotiation until 4 a.m. this morning, one of these strange things in the process where we didn't even expect any transparency negotiations to go, but here we are. But we did come to an outcome, so that's good, but it's also why I'm running late today. Yeah, so thank you. So yes, Anke's asked me to give a little bit of policy context, so I'm going to speak briefly about the safeguard mechanism, the Australian Carbon Credit Unit scheme and Climate Active. So just to kick off, and I'm sure that some of you here actually know a lot more about some of these topics than I do, but just to give you the outline. So Australia's safeguard mechanism was legislated in 2014. It applies to facilities that emit more than 100,000 tonnes of CO2 equivalent in a year, which is about 215 facilities in Australia, collectively amounting to about 28% of our national emissions. And these are across the mining, manufacturing, transport, oil, gas and waste sectors. Early this year, the Australian government reformed the safeguard mechanism. Those reforms came into place as of the 1st of July this year, and they put in place legislated targets that put in place a declining baseline for those emissions, and those baselines are calibrated to require those facilities to reduce their emissions on a trajectory that is on average the same rate across the Australian economy, intended to meet Australia's, to provide a proportional contribution to Australia's 2030 target to 43% below 2005 levels and our net zero by 2050 target. We're projecting that this will deliver around 200 million tonnes of abatement by the end of the decade. And so safeguard facilities can meet these obligations by a combination of on-site reductions and by the use of safeguard credit units and Australian carbon credit units. I'm going to come back to Australian carbon credit units a little bit more. But SMCs, which are the safeguard mechanism credits, are automatically issued to facilities whose emissions drop below their legislated baselines. And they are able to sell these SMCs to other facilities, surrender them to meet their own obligations, or to bank them for future use. Each ACCU and SMC represents 1 tonne of emissions reductions. So I guess just a comment on ACCUs. There are a number of, and SMCs, there are a number of kind of transparency obligations in place to kind of govern the use of those credits towards safeguard baselines. So, for example, if a safeguard mechanism facility surrenders ACCUs equal to more than 30% of its baseline, they must submit a statement to the Clean Energy Regulator as to why the abatement has not been undertaken. And then there is a review scheduled for the safeguard mechanism settings in 2026 and 27, under which the Climate Change Authority will advise on the extent to which that on-site abatement is being incentivised or driven by the reforms, and if there's anything any adjustments required So I'm going to go to the Australian Carbon Credit Units scheme. So the Australian Carbon Credit Unit scheme was legislated in 2011. It's been known by a series of names. It was the Carbon Farming Initiative, then the Emissions Reduction Fund, and now it's the Australian Carbon Credit Unit scheme. It's designed to incentivise emissions reductions across the economy that would otherwise not occur. Each ACCU represents 1 tonne of CO2 equivalent emissions not released into the atmosphere. These take the form of certified financial products that can be sold to the government or to businesses, either for their safeguard mechanism compliance purposes or to meet voluntary commitments, and including under the Climate Active scheme. ACCUs can be sourced from the private market through spot or forward contracts or through long-term take-off agreements. emissions projections released like literally just last week indicate that we expect sufficient ACCU supply through to 2035 at prices below the cost containment measure. We're expected to see strong ACCU supply for the remainder of 2023, and the number here is 18 million ACCUs expected to be issued. There are currently over 100 million ACCUs under carbon abatement contracts that could be delivered to the government, representing around half of the 200 million tonnes of abatement expected from the safeguard mechanism reforms. I'm going to just leave it there. I can come back in more detail if folks want more detail later on.
Thank you very much, Julia. It's been very good to get the scene and setting, the regulatory setting. I'd now like to move to everyone in the panel to maybe share very briefly your stance on the use of carbon offsets to reduce Australia's greenhouse gas emissions in line with the Paris Agreement, and in particular, to what extent should Australian companies rely on offsets to help keep their compliance obligations or under the voluntary net zero targets. So maybe I start with Kurt and then Tennant and then Kate.
Thanks very much, Anke. And for those who aren't familiar with the Carbon Market Institute, we're a member-based institute that's committed to accelerating the use of market-based solutions and also supporting best practice in decarbonisation to limit global warming to 1.5 degrees. It's also worth noting CMI's close relationship with the history of carbon pricing in Australia. We were established in 2011 in anticipation of there being an economy-wide carbon price that would, in fact, was anticipated to drive action. But as many of you will be aware, that particular policy framework was short-lived. But we have since been working in the background to support this notion that Australia can one day move forward on this really powerful concept, as we've done with the reform safeguard mechanism. So from our perspective, we think that carbon pricing mechanisms can be a significant driver of abatement activities and decarbonisation, and we only need look to examples such as the EU ETS to see that they can in fact drive significant abatement potential. In the case of the EU, the estimate is around 37% of reductions having been contributed to by that particular framework. In the context of the safeguard mechanism, CMI did play quite a fundamental role in the design of that. So we actually came up with the proposal to reform the safeguard from its previous iteration into a more effective baseline and credit scheme. And we did a lot of advocacy since 2018. It subsequently was incorporated into Labor Party policy and was taken forward to the election. And as we've heard, it's now been established as of July this year, which is really pleasing. We do recognise, however, that carbon pricing is not a complete solution to industrial decarbonisation, and carbon pricing needs to operate within a broader scheme of investment drivers to get that industrial decarbonisation occurring, which is quite a technical discussion and requires really significant capital investments and innovation to occur. And some of the other really significant drivers that we engage directly on are things like the carbon disclosure framework that's currently also being established in Australia, direct government programs to support innovation such as the Powering the Regions Fund, the Net Zero Authority, which is looking at just transition of the regions, but also some of the important international drivers, notably the UNFCCC process, which we're all engaged in at the moment, but also looking at some of the lessons from other jurisdictions, such as the CBAM that we're seeing in Europe. Australia is going to start entering into that discussion as well. We also recognise the need, though, for deeper structural adjustment within the economy, and this is in the form of investment frameworks to increase research and development and commercialisations of those important decarbonisation investments. We think there is a need for consideration of a regulated approach to phasing out fossil fuels in partnership with Australia's key trading partners, but also assessment of new fossil fuel facilities that will have a significant impact on the carbon budget, which could be implemented through some form of climate trigger. Given, though, that the safeguard only covers a small segment of the Australian economy, at the moment it's loosely the industrial sector, but in reality it's actually not covering all entities within the industrial sector. If you look at, for example, aviation, it's only covering some entities, but not all. In transport, it's not covering all segments of the transport sector. CMI is really committed to looking at how this mechanism can, over time, be scaled and deepened to actually ratchet Australia's ambition over time. So we would like to see potentially it extended to other sectors. We would like to see the thresholds progressively move down so that it starts to apply to a broader range of facilities and activities. Beyond the compliance frame, though, we also think there's an important role for carbon credits and offsetting to support voluntary corporate climate commitments, to enable companies to address their emissions now as they're transitioning and as they're setting interim decarbonisation science-aligned targets. Also, as they reach that point of net zero, to deal with residual emissions, and longer term to also incentivise important investment that will be needed in a negative emissions economy to support carbon drawdown through carbon removals. In the voluntary space, carbon credits enable the private sector to invest in abatement in the broader economy, but also internationally to actually finance some of the abatement in these emerging economies that vitally need climate finance to be redirected to support some of those global goals on climate finance. We recognise, though, that the voluntary commitments need to be underpinned by demand-side integrity, and that needs to reflect international best practice. And what we've seen over the past year is that this is a rapidly evolving and maturing space. We're seeing a range of guidance at the international level, from the Voluntary Carbon Market Initiative's Claims Code of Practice, the ISO Net Zero Guidelines, and other frameworks that are actually enabling companies to demonstrate that they're actually setting science-aligned commitments, and that their use and engagement with carbon markets is part of that overall integrity narrative. We think that decarbonisation does need to be the absolute priority, and that's in terms of transition away from fossil fuels and investment in the decarbonisation investment. But we think carbon credits can contribute towards the transitional approach of these companies and the ultimate goal of net zero and net negative emissions.
Thank you very much, Kurt. Let's move straight on to Tanind.
Thank you very much. So I'm from the Australian Industry Group, a peak industry body representing businesses of many sectors, all sizes around Australia. And I'll offer a few jumbled, disorganised thoughts that might spark some discussion. Trade and division of labour are they're good things, they're helpful things, whether within a national economy or in the world as a whole. We do, in fact, need the net piece to achieve net zero. We're not going to be able to achieve absolute zero across all gases in all sectors of the local economy or the world economy. But there's many ways to structure the net bit. Credits are one way. They can be a very valuable way. They're not the only way to structure those activities. And it's important to distinguish the activities that we're talking about from the means by which we cause those activities to happen. Article 6, so thinking a bit about the international piece as well as the domestic piece, my suspicion is that Article 6 is not going to turn out for some time to come to be quite as important as I used to think that it would be. Well, I'll jump into the reasons why. So there's a lot of analyses out there that tend to say, words to the effect of, there's huge savings to be generated by means of international emissions trading, such that either achieving the NDCs will be a lot cheaper, or you could raise the ambition of the NDCs and achieve a lot more for a given level of economic impact. The thing about those intuitively plausible arguments is the specific numbers are all founded in integrated assessment models that are basically not very good. They're models that have again and again wildly overestimated the costs of abatement in economies that they're applied to. They're stuffed with old technology assumptions. There's all kinds of things like innovation that are very poorly represented in them. And so the result is that they've just got a very bad track record, and we should be really cautious about the narrative that they tend to inculcate, which is that action is really expensive in advanced economies and it's really cheap in developing economies. One dynamic that's really important is the industrial and energy system decarbonisation that we all know needs to happen is super capital intensive, and developed countries enjoy a much lower cost of capital than developing countries who aren't China. And so actually decarbonisation in significant chunks may be easier in advanced economies than in many developing countries, at least without support. So how much reliance should nations be placing on carbon credits? It really depends on like what we're trying to achieve and where we're at. We can distinguish like -5% land, where we're looking for marginal improvements on existing activity, and at minimal cost, least cost, but really incremental point targets a little way into the future rather than the full sweep of decarbonisation. That we're past that land. That's not what we're talking about anymore. Then there's net zero land, where there's just big chunks of meat and potatoes decarbonisation to be done in national economies. Some trading around within the national economy, some negative emissions needed around the margins to make that work. But really, the meat and potatoes are core there. Then what we're not yet grappling with, but we need to be heading towards, is net negative land. And that's that's going to need a lot of negative emissions, like boatloads of negative emissions. They could be structured as credits, they could be structured as other kinds of arrangements, but there is a huge disparity between capacity to pay and capacity to do on large-scale negative emissions. And so eventually, whether it's through Article 6 or other means, I think that international trade will be super important. I'll just close out for this opening by saying, what's the purpose of credits and crediting within national policy scheme design? What are we trying to do with that? And one goal could be to smooth out abatement costs among emitters. And that's a really important thing. You could get super huge spikes in abatement costs for particular emitters at particular pinch points of time because their options are not smooth. We're talking about large transformative investments that take time to happen. But if we're talking about between countries smoothing out those abatement costs, actually that may not be desirable. There are different ambitions between countries. There are different paces at which they're willing to move. Europe does not want its domestic carbon price to converge with carbon prices in Zambia or the United States or wherever. They have a level of change they want to achieve internally. If we're doing it to achieve lower overall abatement costs, we have to think about, well, is that actually what we want? Over the very long term, the full sweep, yes, we do want to achieve that full transition at least cost, but it's worth doing expensive things now as a part of that. If they have the potential to get cheap by doing more of them. And if we want it for competitiveness reasons, well, Kurt uncorked the CBAM. There are other ways of coming at competitiveness, and I'll stop there.
Thank you very much, Tenan. Kate.
Yes, thanks. So I'm a research fellow at Melbourne University, as was said, and my work focuses mostly on land sector, forest governance, land sector governance, and carbon offsetting in that context. And I feel like I need to talk more quietly rather than loud to compete with that noise out there. Most of what I'm going to cover now, just very briefly, is in a submission we made during the state safeguard mechanism reform consultation process. And I want to start actually just quite broadly with differentiation of targets. So if we think about net zero net zero carbon by 2050 is a global goal for achieving for limiting warming to 1.5. So it's a global goal. It doesn't apply at the nation state level, and countries need to be, wealthy countries like Australia need to be more ambitious than that in the spirit of differentiation of targets, so that poorer countries have a little bit more time to decarbonise. So in terms of our 2030 targets, there's plenty of scientific analysis in Australia that suggests we should have a target more like 75% than 43% for 2030. And then I think taking perhaps not the same principle, but a similar principle to the safeguard mechanism, the proportional baseline, I think, is a little bit problematic because the energy sector has more capacity to decarbonise quickly than, for example, the agriculture sector. And so having more differentiation in that baseline among sectors, or in those targets for pathways for mitigation among sectors in Australia, would help to spread the mitigation burden where it is more achievable economically and sort of capacity-wise. And then there's another reason for that, is that for that sort of needing to change the proportionality between different sectors in terms of their mitigation contribution. The land and agriculture sector, so well, maybe before I go there, if we look at the use of ACCUs, Australian Carbon Credit Units, in the safeguard mechanism, there's some analysis suggesting that at least over 30% of the abatement will likely be done through land sector offsets. And there is a finite potential for the land sector to be used as offsetting, or to remove or avoid emissions. So that leaves it much more difficult for the agriculture sector, who will also need to offset emissions later on when that's needed. And also, going to Tennant's point, it makes it more difficult when we get to the point of needing to go net negative if we've already used the land sector abatement in an easy to abate sector very early in our abatement process. So that's one reason why I think that there's an over-reliance on offsets in the safeguard mechanism. There shouldn't actually be any reliance on land sector. I guess that argument was about an over-reliance on offsets, and then I don't think there should be any land-based offsets in the safeguard mechanism. I think offsets should be limited. A 5 to 10% supplementarity cap would be in line with international sort of standards, compared to the sort of 30% encouragement that I would call it at the moment. But then in terms of land sector offsets, there's a fundamental lack of equivalence between removing carbon into biological sinks, which is land and forests, versus which are temporary, versus permanent carbon emissions from fossil fuels. So those growing trees effectively, and there's again a lot of science to support this, there is a temporary climate benefit from removing carbon into trees and into the land sink, and that's really important. It's an important climate benefit for the next 50, 60, this century, while we try and limit peak temperatures. It's also important opportunity for the land sector to regenerate. But that temporary climate benefit is lost if, at the same time as removing that carbon into trees, we use it to offset a permanent fossil fuel emission. Then we will never achieve that temporary climate benefit. Ultimately, there'll be increased warming from those offsets. So I think I just wanted to maybe circle back around to my first point about targets and net zero. So net zero as a scientific concept, and in the IPCC, is not as clear as it could be, largely because of these problematic IAM models. But it actually does require something like 90% emission reductions in CO2, carbon emission reductions by 2050. The whole balanced net zero thing has been framed as balance any way you like, but it's not. It's balancing the last 5 to 10% of residual emissions with offsets and removals. And in Australia, there's a report from the Australian Industry Energy Transitions Initiative suggesting that the energy sector could directly reduce emissions by 92% by 2050. So this is the kind of trajectory that this sector should be on. And I think the question around carbon markets and offsetting and flexibilities should be, to what extent are they being used to enable and speed up that pathway and that transition, rather than slow it down.
Thank you very much, everyone, for providing your perspectives. In the interest of time, let's move to sort of a deeper discussion around three key themes. The first one being a focus on the safeguard mechanism, and especially the reforms, and how you think companies are reacting to this, and in particular with respect to how they are using carbon credits to manage their obligations under the safeguard mechanism. Perhaps first question to Tennant. Can you talk a little bit about how different companies in different sectors maybe approach this problem?
So I think we're going to need to check back next COP, because there's a bunch of parties regulated by the safeguard mechanism who, as of today, are probably still not sure what their liabilities are going to wind up being. There's been a lot of important work continued to be done since, what was it, April, when the reforms were settled, to flesh out a lot of important features. And so I think, and like CMI will have a view on this, I think there's a lot of waiting and seeing going on with respect to what their offset acquisition versus... There is a lot of activity going on among members in that space around what is my actual internal decarbonisation pathway, not just what are the options, but when are they investable, under what conditions are they investable. And I think a lot of people have been waiting to see this safeguard surge of demand go into the ACCU market, and it hasn't quite happened yet. But it is coming, because I don't know that there's a very large number of transformative investments that are going to be completed and achieved and start delivering before the first compliance year is done.
Okay, so then that sounds a little bit as if the availability of carbon credits allows firms to take this wait-and-see approach and not invest straight away in on-site decarbonisation at a larger scale?
So I don't know anybody who in my membership or elsewhere who thinks that there's going to be this endless supply of cheap credits that, you know, they can just put things off and well, not quite sit in a hammock, but concentrate on other things. That's pretty unwise, because there are the sorts of physical limits that Kate referred to, and then the next increment, once you run out of that plausible land sector stuff, if you have access to it or not, the next increment is is engineered carbon removals, which are going to be very expensive. They'll have a role. They'll have a gigantic role, actually, because we're not on track to achieve 1.5 globally without a boatload of net negative, and we need a lot of thinking about how that's actually going to be achieved. The physical part of that, but then the who pays and how part is huge. Anyway, I don't see members just sitting on their duffs on this, but they are trying to work out what they actually need to buy. Okay. Or achieve by first true update for the reformed safeguard.
Okay, so a very important aspect of deciding what to do is what the projections are for the ACCU prices, for example. And that's obviously an interplay of demand and supply. So, Kurt...
Yeah, and I just respond a little bit to the comments that have been made thus far. I think we need to distinguish between the compliance frame and the best practice frame. So the safeguard mechanism sends a long-term signal to those companies. This is the direction of travel. This is where you'll need to get to by 2030 and beyond. It is true to say that it's agnostic on how much they're relying on offsets, but all companies are going to have to go through that exercise of what I mentioned at the outset of prioritising decarbonisation, and that for many of these companies that are in the hard-to-abate sector, that's a technology question of when that technology is going to be available and cost-effective, but it's also one of how long it's going to actually take to bring those projects online. So even for companies where they do have an immediate technology solution, it's not necessarily readily implementable. It will actually take 2 to 3 years for it to come online. They can't just switch it on. So that's, I think, important to bear in mind. From a supply-demand perspective, what we've heard is that, yes, there is quite a sufficient degree of supply, and that is also because the government has enabled the release of some of its own ACCUs into the market to ensure that there is sufficient supply in the short term. But we understand that that is likely to tighten towards the late 2020s. And that's because we're also going to see constraints from other sectors as well. So as we mentioned earlier in the discussion, there is going to be a need for other sectors to also face a carbon constraint, notably agriculture, transport, and we also do have demand drivers coming from voluntary commitments of corporates and indeed state governments. So those are all playing into the same ACCU market. And there is only a limited supply. So if you look at the estimates on a very conservative view of it, the view is that we could have at the conservative end something around 37 million tonnes a year, and then at the really ambitious end, it's more around 1.3 million tonnes. So it's very different, and that depends upon a range of different inputs. So it will be interesting to see how that plays out. But I think in terms of the scheme design itself, CMI's view is that the government probably should have been a little bit more open about what the government's own view of supply demand would look like in order for the market to be able to then put forward a view on what kind of constraints should be put on the use of offsets. And I do take the point that potentially in future we should have some sort of limitation to actually create a pointier driver for at-point decarbonisation. But there's other ways that you could do that. So one of the options that CMI put forward to government is the potential to have vintage limits on the credits, which would mean that, and that would be a rolling vintage limit. So particular credits would have to be used within a 5-year window. And what that would do is it would mean companies wouldn't be able to just buy credits for their entire period of compliance obligation to 2030 and beyond. They would actually have to continually think about where is the investment opportunity, how are we managing our risk. So it would put the onus on them to come back to that core question of decarbonisation.
Yeah. Thank you. Maybe this is a good time to circle back to you, Julia, especially on the kind of your forecast about carbon credits and.
Yeah, thank you, Anke. So I do have exactly the numbers that are in the 2023 emissions projections on these, and I think it does really point to that kind of issues around supply and demand. So the projections expect that the ACCU supply is projected. So we've got 18 million ACCUs expected to be expected to be issued in the remainder of 2023, and demand to continue to increase with peaking in 2031, I'm sure. But that the issuance to be greater than demand, for that the supply to be higher than the demand all the way through to the end of 2027, increasing the holding of units. And then between 2027 and 2032, the projections say that demand is expected to temporarily overtake new issuance, which will be met by existing holdings. And then from 2032 on, they're expecting that demand supply to flip. So,
okay.
Yeah, but I think that really kind of points to questions about vintage limitations and what that means, and the relative incentives in the short term versus long term.
I see. Thank you very much. So having talked about the safeguard mechanism, this is of course covering only about 30% of Australia's emissions, so it's really important to understand how the use of offsets is used to achieve voluntary net zero. And there in particularly, I'd like to think about whether carbon offsets are being used to address certain categories of Scope 3 emissions, for example, at the moment in the voluntary market. And maybe that is a question for you, Tenen.
So, the voluntary use of offsets and voluntary action in general is in an evolving context. Compliance schemes of various sorts, I mean, I don't know if everybody's pining for like one big scheme to rule them all anymore. but certainly compliance policies and robust policies need to spread, as Kurt indicated, to more sectors. Companies seeking like a voluntary thing to do on top of whatever their current compliance obligations are, they really need to think about what they're trying to achieve, and purchase of high quality offsets with co-benefits that are important to them or to their stakeholders. That is one way to go. Another way, and it can be a very useful one, another way to think about it though is, well, where can I make a difference in pushing the frontiers of decarbonisation? And the sort of work that Microsoft has begun funding, where they are doing advanced purchase commitments for incredibly expensive forms of negative emissions, to get like a bit of a market going for those technologies, and with like some really quite ambitious goals of ultimately wiping out their own historical contribution, not just achieving net zero at a point, but net zero over the whole of their existence. Not everybody's in a position to do that kind of thing, but that's a very constructive way to go. The other thing is safeguard mechanism. There was a report from the Productivity Commission, the Ancien Regime Productivity Commission, earlier this year, saying safeguard should expand. That you should bring in transport and electricity and sub-100 kilotonne facilities. They are pining for a one big policy. So there's a lot of ways to come at this.
I see. Now, Julia, just briefly, how do you see that maybe the foreshadowed, can you hear me? Yeah. The foreshadowed reforms for the climate active standards, how they may shape corporate approaches to using offsets? I heard, or it's in the press, that those standards are going to be a lot tighter in the future. Perhaps you could comment on that.
Under Climate Active?
Yes.
I'm not sure I am best placed to speak to Climate Active.
I've got some comments on that.
Okay,
yeah.
sure.
Yeah, so I agree with the comment around the need for compliance markets to scale, but the voluntary carbon market also has a critical role to play globally in supporting abatement activities. And from CMI's perspective, we think that the government can actually support high integrity corporate approaches in terms of demand-side integrity. And we think Climate Active is a very unique program when you look globally because it is government-backed. But in order to do that, we think the government needs to lean into some of the international integrity initiatives that I mentioned at the outset. So we've had, just at COP, we've had the announcement of what's being called an end-to-end integrity framework. The Voluntary Carbon Market Integrity Initiative has developed this claims code of practice, which really requires that companies that are engaging with carbon markets actually set science-based or science-aligned targets at the outset, that they then set that they're committed to interim decarbonisation targets, and then when they're looking to procure carbon credits to account for their remaining emissions, that they endeavour to secure high integrity credits. And so that framework has been now linked with the work of the ICVCM with their core carbon principles. It's been linked with the Science Based Target Initiative, CDP and others. And that now provides a kind of end-to-end integrity framework to support corporates. On the question of Scope 3, I think there is some room there for some flexibility in the use of offsets, given that, even in the Australian context, we don't really even have a very robust framework to support companies actually assess and report on Scope 3 emissions. But I think there is a role there for carbon credits to contribute. So the VCMI framework has recently released further guidance to say, in the case of Scope 3, in some instances it does make sense for you to purchase carbon offsets to contribute towards your Scope 3 emissions. But I think ultimately we're moving towards this this evolution of the market where we do want all companies to subscribe to a high degree of demand-side integrity. And we are seeing some early adopters of that. So with respect to the VCMI, there was an event last week where BCG, Bain & Company and Natura have said that they're going to get behind that framework. Obviously, under the SBTI, we've got over 2,000 organisations already committed. And then I also mentioned at the outset, there's also the ISO Net Zero guidelines, and we're seeing a number of large companies like Netflix, General Motors, start to look at that framework as another reference.
Right. Okay. I'm a little bit conscious of time, and we have talked a lot about the safeguard mechanism and the markets. I now would like to turn to the science more, especially considering the risks of relying heavily on offsets to negate corporate emissions, ensuring that offsets represent real emission reductions on the pathway to net zero. And that's, of course, very important to the success of a safeguard mechanism and also broader net zero transition. So, Kate, are all offsets created equal? And if you could talk a little bit about the risks specifically around using offsets.
Mm-hmm. Yeah, sure. So obviously not all offsets are equal, and we've just heard a lot about the different standards, and there's a lot of work the last few years around certifying offsets as high integrity and making sure offsets are high integrity. But I don't think all of that work is in line with the science. And there tends to be, in particular, a fundamental issue that's ignored when thinking about offsets. So high integrity offsets are, well, I mean, we don't want very poor integrity offsets that drive human rights abuses and don't deliver mitigation. So high integrity offsets, it's important to define what that means. But what I was talking about before, in the mitigation framework, we talk about emission reductions, removals, and avoided emissions. So already avoided emissions have been kind of crossed off the list as something that's a credible thing to be able to measure and understand what it is. The Chubb review recommended to remove avoided emissions from the ACU scheme, so that was great. Same things happening in Article 6, same things happened with the core principles under ICVCMI. So I won't talk about that, why that's so problematic. It's already been agreed. Then we have emission reductions and removals. Emission reductions are reducing emissions compared to previously, so an absolute reduction, and that's pretty straightforward. That's a good thing. You could trade between different kinds of emission reductions, as we have with the safeguard mechanism credits. I think that's a really good part of the safeguard mechanism framework. But then when it comes to removals, there's the issue that's being discussed is we have non-permanent removals into land and potentially permanent removals through negative emission technologies that are geologically stored. But this is in the future, very expensive. The Microsoft innovation is interesting. Non-permanent removals into land, as I was saying before, they don't deliver a climate benefit if they're used as an offset. They do deliver a climate benefit if they're not used to offset emissions. So in terms of company thinking about what companies should do, because the technological tech-based removals are difficult and expensive, and a short-term immediate priority is to fund nature restoration. So something that under Article 6 has been called mitigation contribution units, in terms of still funding that removal of carbon into land, but not calling it an offset. So the company isn't carbon neutral, but it would be clear that what the level of absolute emission reductions are, and what the funding contribution is to nature restoration. And I think that would be a very high integrity, transparent, robust goal compared to claiming climate neutrality. And just to wrap up on that, again, from a science perspective, going back to my point about net zero by 2050 being a global goal, it doesn't apply at the company level. We do not need climate neutrality from every company. And it's great that this sort of aim for that is driving innovation and aspiration among companies, but it's not great if that drive to be climate neutral sort of obscures unscientific practices such as land-based offsetting.
Wonderful. So we are a little bit out of time, but I want to give everyone a chance, given that there's quite a little controversy around the use of carbon offsets, to sort of spend maybe a minute talking about, taking into account what everyone else said, what you think the way forward should be for the use of carbon offsets in Australia to align us with the Paris Agreement. Who wants to go first? 1 minute.
Oh, that's hard. So I think that this discussion would actually be a lot easier if we weren't, for understandable reasons, all in a bit of a defensive crouch. Like if we are seriously engaged with how are we making ambitious, rapid journey to net zero and then like plunging through net zero into net negative happen, like we know that a lot of stuff needs to be done to achieve that. And if we are not needing to fear that that structuring things as offsets or doing land sector or whatever else will be used as an excuse not to do the things that we know we definitely need to do, then we can have a much more constructive discussion. Because I will differ. I think that land-based offsets do have an important role. And my most annoying opinion here might be actually land-based offsets are a terrific fit with methane related reductions, because methane also has a short-term impact. Anyway, I think that the minority of bad faith actors in the debate is making it very hard for a lot of people with different perspectives but good faith to have a really productive conversation.
Great. Who wants to go next?
I do actually, because I want to respond to that. So I actually think it's time limits more than anything else that prevent productive conversations. Every conversation is time constrained. But I was saying that land-based offset, temporary removals into land doesn't offset permanent fossil fuel emissions. So that means it can offset temporary methane removals because they also are temporary. It's all about the time span, the residence time of the atmospheric gases. So there is scope for the land sector to play a big role, and particularly that's also why I was talking about agriculture. There are a lot of residual emissions in the agricultural sector, and agriculture and land use could be net zero together, while energy needs to be much closer to absolute zero. And just what we talk about offsets a lot, and I feel like when we talk about carbon pricing, we almost immediately go to talking about offsets, and in the middle is carbon markets, which don't always include offsets. And above carbon markets in my hierarchy is carbon pricing, which doesn't always include carbon markets. There are so many economic incentives and applications of a carbon price and offsets are a really small piece of that story.
Thank you. Kurt.
Yeah, just a few points. I think at the macro level, Australia does need to start thinking more comprehensively about how we scale and deepen market-based frameworks, thinking about the adjacent sectors and whether it's appropriate to have some sort of market-based framework or linkage with the safeguard mechanism. I think on the discussion around removals, there does need to be some policy consideration to some form of governance framework in Australia so that it doesn't extend the life of fossil fuel assets, for example, and it's not applied in that context. I think on the point around avoidance, I don't think that debate has fully been put to bed. I think globally we've got the Glasgow Leaders Declaration on ending and halting forest loss. So there actually does need to be relevant incentives to have some action occurring there, if it's through carbon markets or elsewhere. That's important. And then I think in the micro level of the company commitments, it's necessary to have more government guidance on what best practice looks like.
Wonderful. And the last word to Julia, government perspective.
So I guess, I was just going to offer a short, from my own perspective as a negotiator in the process, and I think some of what Tennant and others were speaking about in terms of being able to create the space for the conversation for decarbonisation and to get outside issues of blame and that kind of really apply at the level of the process as well, because we're seeing that, so what we're seeing here is real pushback from those countries that have kind of most at stake in the rapid decarbonisation, and the more and more squeaky they get, the more and more you kind of know that these things are starting to bite. So it just those questions of timing and what's actually available when, and how you make those things available in a way that supports really constructive engagement is super important. I think that applies at the scale from what we're seeing in the process here on all the way from big signals on mitigation ambition down to how you actually deliver it and the role of market mechanisms in that process. Yeah.
Okay, let's close it here. Let's thank everyone, Julia Gardiner, Kurt Winter, Tennant Reed, and Kate Dooley for their excellent insights. And thank you so much.